Welcome to the program You Can Beat the Stock Market. Here we show you how you can beat the stock market even though you're not a pro like Warren Buffett. I am Francisco and today we're going to show you why thinking beyond the stock market average can make you beat the S&P 500 index. But wait, what does the stock market average means? The stock market average is like a temperature check of the stock market. It gives us an idea of how stocks, which are pieces of companies that people can buy, are doing overall. When we talk about the stock market average, we usually mean the average price of a bunch of different stocks. One popular stock market average is the S&P 500 index. This index looks at the 500 of the biggest companies in the United States and takes an average of their stock prices. Investors like the S&P 500 because it includes a wide variety of companies, from technology to healthcare to retail. So it gives a good snapshot of the entire market. If the S&P 500 is going up, it usually means that, on average, companies in the US are doing well. If it's going down, it means that companies are facing some challenges. That's why you investors use it as a quick way to understand how market is doing. Investors put their money into stocks, bonds, or other things, hoping to make more money over time. This extra money they make is called a return. They often compare their returns to the stock market average, like the S&P 500, to see how well they're doing. Now, why would investors want higher returns than the market average? Well, it is like getting a better score in a game. If the market average is going up by 5%, but an investor's stocks are going up by 8%, they are winning. They are making more money than the average investor. But it's not about winning. Investors might have specific goals, like buying a house, paying for college, or retiring comfortably. Making more money can help them reach these goals faster. So, wanting higher returns than the market average is a bit like wanting to run faster in a race. It's about doing better, reaching goals, and feeling good about your investments. Mention potential risks and the importance of understanding them. When investors try to get higher returns than the market average, it's a bit like going faster on a bicycle. You can get your destination quicker, but it can also be riskier. You might fall or have an accident. In the world of investing, taking more risks can mean higher rewards, but it can also lead to bigger losses. For example, an investor might buy stocks in a new tech company that could become the next big thing. If it does, they could make a lot of money, but if the company doesn't do well, they could lose money. That's why understanding risks it is so important. It's like knowing the road before you cycle on it. You need to know about the bumps and turns ahead. In investing, this means knowing about the companies you invest in, how the market works, and what could go wrong. But understanding the risks, investors can make smarter choices. They can decide how fast they want to go and how much risk they're comfortable with. It's all about finding the right balance between going after big returns and staying safe. Let's talk about three popular market indices: the S&P 500, Dow Jones, and Nasdaq. They're like scoreboards that show how the stock market is doing. S&P 500, this index tracks 500 of the biggest companies in the United States. It's like a soccer team made up of the top players from all around the country. It includes companies from all industries like tech, healthcare, and finance. This variety is one of the reasons why many people think it's the best index. It gives a broad view of how the whole market is doing. Dow Jones. This index looks at only 30 large companies. It's like a smaller team with fewer players because it has fewer companies. It might not give as complete a picture of the market as the S&P 500. Nasdaq. This index includes lots of companies, but it focuses on the tech industry. It's like a team of only goalkeepers. If you're interested in tech, it's great, but it might not give you a whole picture of the market. So, why is the S&P 500 considered the best by many people? It's because it's like a well-rounded team with top players from every position. It includes a wide variety of companies, so it gives a good overall view of the market. Plus, it has 500 companies, which is more than the Dow Jones and covers more than just tech, unlike the Nasdaq. In short, the S&P 500 is seen as the best index by many because it gives a broad, balanced view of the stock market. It's like a team that has a mix of great goalkeepers, defenders, midfielders, and strikers. Okay, let's talk about how an average investor's portfolio might beat these indices like the S&P 500, Dow Jones, and the Nasdaq. Do your homework, study companies before investing in them. If you learn a lot about a company and believe it has a bright future, you could invest in the stock. If you're right, the stock might go up a lot, and your portfolio could beat the indices. Diversify. Don't put all your eggs in one basket. Invest in different types of stocks. That way, even if one investment does poorly, others might do well. This balanced approach can help your portfolio do better than the indices. Buy low, sell high. This is a simple but powerful idea. Buy stocks when their prices are low and sell them when their prices are high. If you do this well, you can make a profit and your portfolio might beat the indices. Think long term. Instead of trying to make a quick profit, think about the long term. Invest in companies you can believe will grow over the years. This patient approach can help your portfolio do well over time and might beat the indices. Get expert help. Attend an online investment course or get a mentor to help you make smart choices. Expert advice can help you build a strong portfolio that might beat the indices. Reinvest dividends. Some stocks pay dividends, which are little bonuses. Instead of spending them, you could reinvest them to buy more stocks. Over time, this can help your portfolio grow and might help it beat the indices. Remember, investing is like a marathon, not a sprint. It's about making smart choices and being patient. If you do these things, your portfolio might beat the indices like the S&P 500, Dow Jones, and Nasdaq. High returns usually come with high risk, but not always. Sometimes you might find a stock that does really well without a lot of risk. It's like finding a hidden treasure, but these stocks are rare and it's hard to predict which ones will do well. From 2010 to 2020, some stocks did much better than the S&P 500 index. Here are 10 examples: Apple, Amazon, Netflix, Tesla, Nvidia, Microsoft, Alphabet, Google, Facebook, MasterCard, and Visa. If you had invested $1,000 in each of these stocks in 2010, here's roughly how much you would have made by 2020. Apple, $12,000. Amazon, $22,000. Netflix, $51,000. Tesla, $159,000. Nvidia, $23,000. Microsoft, $8,000. Alphabet, Google, $3,000. Facebook, $4,500. Remember that Facebook went public in 2012. MasterCard, $4,000. Visa, $3,500. Adding the earnings of these 10 stocks, we have a total of $292,000. Amazing, isn't it? If you had invested $10,000 in the S&P 500 index in 2010, you wouldn't have made roughly $30,000 by 2020. So, by investing in these stocks instead of the S&P 500 index, you could have turned $10,000 into $292,000 instead of $30,000. But remember, even though these stocks did great from 2010 to 2020, they might not do as well in the future. Investing is always a balance between risk and reward, and it's important to do your homework and understand the risks before investing. When investors go after high returns, they sometimes make mistakes. Here are some common ones. Not doing homework. Some investors buy stocks without studying the companies first. It's like buying a car without checking if it works. Always research before investing, following the crowd. Sometimes, when a lot of people are buying a stock, others join in without thinking. It's like following a crowd without knowing where it's going. Make your own decisions. Being impatient. Some investors want to make money quickly, so they buy and sell stocks often. It's like planting a tree and digging it up to check if it's growing. Give your investments time. Not diversifying. Some investors put all their money in one stock. It's like putting all your eggs in one basket. If the stock falls, you could lose a lot. Spread your money across different investments. Ignoring fees. Some investors forget about fees. It's like ignoring small leaks in a boat. Over time, fees can add up and eat into your returns. Letting emotions rule. Some investors make decisions based on fear or greed. It's like eating a whole cake because it tastes good, but then feeling sick. Stay calm and think clearly, not understanding risk. Some investors take on too much risk without realizing it. It's like driving fast on a rainy day without knowing the road is slippery. Understand the risk before investing. Not having a plan. Some investors don't have a plan. It's like going on a trip without a map. Know your goals and make a plan to reach them. Remember, it's normal to make mistakes. But by being aware of these common ones, you can avoid them and have a better chance of getting higher returns. Just like learning to ride a bike. It might make some faults, but with practice you can get better at investing. Active investing is a bit like being a detective. You're always looking for clues about what the market will do next. Just as detectives might read reports, interview people, and collect evidence, an active investor constantly analyzes the market. Here's how it works. Reading reports. Active investors read a lot of reports about companies and the economy. It's like reading a bunch of mystery novels to find clues. These reports can give hints about how a company is doing and where it might be going. Watching the news. Active investors also watch the news to learn about big events that might affect the market, like changes in government policies or new inventions. It's like listening to the radio for news about a big storm that's coming. Studying trends. Active investors look at charts and graphs to spot trends in the market. It's like looking at the footprints to see which way someone went. These trends can give clues about where the market might be heading. Talking to experts. Active investors often talk to experts to get their opinions. It's like a detective asking a scientist to analyze a piece of evidence. Experts can provide valuable insights that help active investors make decisions. Making quick decisions. Active investors sometimes need to make quick decisions based on their analysis. It's like a detective chasing a suspect. If they think a stock will go up, they might buy it quickly. If they think it will go down, they might sell it. In short, Active investing involves constant market analysis. It's like being a detective who's always looking for clues and trying to solve the mystery of where the market is going. It takes a lot of work and attention, but for some investors, it's an exciting and rewarding way to invest. Buying or selling based on short-term movements is like trying to catch a ball that's bouncing up and down. You watch the ball closely and try to catch it at the right moment. In investing, it's called trading, and it's about trying to make money from small changes in the stock prices. But just like catching a ball can be tricky, trading can be risky, and it's important to understand the risks before jumping in. Most fortunes in the stock market are made by investors who make use of value investing and growth investing strategies, not the ones buying or selling based on short-term movements. Define value investing and how it seeks undervalued stocks. Value investing is like shopping for a bargain. Imagine you are at a store and you find a shirt on sale. The shirt is good quality and worth more than the sale price. You buy it because you think it's a great deal. Value investing works the same way, but with stocks. Here's how it works. Find undervalued stocks. Value investors look for stocks that are selling for less than they are worth. It's like finding a shirt on a sale. These stocks are called undervalued. Do your homework. Value investors study companies carefully to figure out what a stock is really worth. They look at things like the company's profits, debts, and competition. It's like checking the quality of a shirt before buying it. Buy and hold. Once they find an undervalued stock, value investors buy it and usually hold on to it for a long time, even years. It's like buying a good quality shirt and wearing it for many seasons. Wait for the market to catch up. Value investors believe that over time the stock market will recognize the true value of the stock and the price will go up. It's like waiting for others to notice how great your shirt is. Sell at a profit. Once the stock price goes up to what the value investor thinks it's worth, or even higher, they might sell the stock and make a profit. It's like selling your shirt to someone who really wants it. In short, value investing is like shopping for bargain. It's about finding undervalued stocks, doing your homework, and waiting for the market to catch up. It's a patient and careful approach to investing that can help you find great deals and make a profit over time. Just like shopping for a sale, it takes time and effort, but the rewards can be worth it. Warren Buffett is a great example of a famous value investor. He's like a wise old owl who carefully watches the market and picks up bargains. Over many years, he has made a lot of money by finding undervalued stocks and holding on to them for a long time. Here are some other famous value investors. Benjamin Graham. He's like the grandpa of value investing. He wrote a book called The Intelligent Investor that many value investors still read today. He was also Warren Buffett's teacher. Peter Lynch. He's known for his saying, invest in what you know. He thinks you should buy stocks in companies you understand. Like if you love a certain brand of shoes, you might buy stock in that company. Seth Klarman. He's a very careful investor who looks for undervalued stocks and holds on to them for a long time. He wrote a book called Margin of Safety that's very popular among value investors. Joel Greenblatt. He's known for this magic formula for investing. It's a simple way to find good undervalued stocks. He wrote a book called The Little Book That Beats the Market that explains his approach. Charlie Munger. He's Warren Buffett's right-hand man and a very wise investor. He's known for his witty sayings about investing and life. Here are some of them. A great business at a fair price is superior to a fair business at a great price. The big money is not in the buying and selling, but in the waiting. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. They go to bed every night a little wiser than they were when they got up. And boy, does that help, particularly when you have a long run ahead of you. Always take the high road, it's far less crowded. Take a simple idea and take it seriously. Like Warren Buffett, I had a considerable passion to get rich. Not because I wanted Ferraris, I wanted independence. I desperately wanted it. These value investors are like wise old owls who carefully watch the market and pick up bargains. They do their homework, buy undervalued stocks, and hold on to them for a long time. Over the years, they've made a lot of money by being patient and careful. Just like the story of the tortoise and the hare, slow and steady can win the race. Growth investing is like planting seeds for fast-growing plants. You're looking for plants that will grow quickly and become big and strong. In the world of investing, growth investors are looking for companies that are growing fast and will keep growing in the future. Here's how it works. Find fast-growing companies. Growth investors look for companies that are growing quickly. It's like looking for seeds of fast-growing plants. These companies might be making a new product that's very popular or expanding into new areas. Look for future growth. Growth investors try to find companies that will keep growing in the future. It's like looking for a plant that will keep getting bigger and stronger. They look at things like the company's plans, the competition, and the overall market. Invest for the long term. Once they find a fast-growing company, growth investors usually invest for the long term. It's like planting a seed and waiting for it to grow into a big plant. They hope that the company will keep growing and the stock price will go up. Accept the risks. Growth investing can be risky because fast-growing companies can also fall quickly. It's like planting a seed for a plant that might grow fast but could also get sick quickly. Growth investors need to be ready for ups and downs. Look for high returns. Growth investors hope to make a lot of money from their investments. It's like hoping your fast-growing plant will produce a lot of beautiful flowers. If the company keeps growing, the stock price will go up a lot, and the investor could make a big profit. In short, growth investor is like planting seeds for fast-growing plants. It's about finding companies that are growing quickly and will keep growing in the future. It can be risky, but it can also lead to high returns. Just like gardening, it takes time, patience, and a good eye for what will grow. Growth investing, like planting fast-growing seeds, has both risks and benefits. Let's talk about them like we're talking about gardening. Stock prices can fall. Just like a fast-growing plant can get sick and die, a fast-growing company can have problems. And the stock price can fall. Maybe the company's new product isn't as popular as they thought, or they have double expanding into new areas. More volatility, fast-growing companies can have big ups and downs. It's like having a plant that grows a lot in the spring but loses all its leaves in the fall. The stock price can change a lot, and you have to be ready for that. High valuations. Sometimes fast-growing companies are very popular, and their stock prices are high. It's like paying a lot for a special seed. If you pay too much, it can be hard to make a profit, even if the company keeps growing. Competition. Fast-growing companies often have a lot of competition. It's like planting a seed for a plant that many other gardeners are also growing. If the competition is too strong, it can be hard for the company to keep growing. High returns. When you plant a fast-growing seed, you can get a big plant quickly. In the same way, growth investing can give you high returns if the company keeps growing and the stock prices goes up. Exciting opportunities. Fast-growing companies are often in exciting industries like technology or renewable technology. It's like planting a new kind of flower that's just been discovered. You can be part of something new and exciting. Long-term growth. If you pick up a company that keeps growing for many years, you can make a lot of money over time. It's like having a plant that keeps giving you beautiful flowers year after year. In short, growth investing is like planting fast-growing seeds. It has benefits like high returns and exciting opportunities, but it also has risks like stock prices falling and high valuations. Just like in gardening, you need to be patient, do your homework, and be ready for ups and downs. Learning to invest in the stock market is like learning to ride a bike. At first it can be confusing and even a little bit scary, but with the right guidance, you can learn how to do it well and enjoy the ride. That's where an online course or a mentor can help. Step-by-step instructions. An online course is like a book that teaches you how to ride a bike. It gives you step-by-step instructions and explains things in a simple way. You can learn at your own pace and go back to any part you need to review. Learn from experts. The people who create these courses are often experts who have been investing for many years. It's like learning to ride a bike from a professional cyclist. They can share their knowledge and experience with you. Practice in a safe environment. Some online investment platforms let you practice investing with virtual money. It's like riding a bike with training wheels. You can try things out and learn from your mistakes without risking real money. Mentor personalized advice. A mentor is like a friend who teaches you how to ride a bike. They can give you personalized advice based on your goals and situation. They can help you avoid common mistakes and give you tips that you might not find in a course. Learn from their experience. A mentor has been through the ups and downs of investing. It's like learning from someone who has ridden a bike in all kinds of weather and on all kinds of roads. They can share their stories and lessons with you. Emotional support. Investing can be stressful sometimes. A mentor can give you emotional support when things get tough. It's like having someone to cheer you on when you are learning to ride a bike. Attending an online course or getting a mentor is like getting help to learn to ride a bike. You can get a step-by-step instructions, learn from experts, and get personalized advice. It can make the journey smoother and more enjoyable. Just like riding a bike, investing can become a fun and rewarding part of your life with the right guidance. Hey folks, thank you so much for watching this video. I hope you found it helpful and learned something new about stock market investing. If you enjoyed it, please give it a thumbs up and share it with your friends. That really helps us out. Don't forget to hit that subscribe button and turn on the notification bell so you never miss out on any of our future videos. We have a lot of exciting content coming up that you won't want to miss. If you have any questions or want to share your thoughts about investing, please leave a comment below. We love hearing from you. Remember, investing is a journey, and we're here to help you every step of the way. Happy investing, and we'll see you in the next video.